Maria, listening to Michael talk about build versus buy, the knock on New York has always been that we don't have a lot of big companies come out of here, that we all sell cheap. Are all these fintech companies in New York gonna just get gobbled up? Or do you have a sense that there's going to be a few big ones that come out of New York? And in which subsector of fintech do you think that will be?
So I don't think that's just a New York question. I think that's an industry question. And the parallel that I use is actually, oddly, pharmaceuticals. So you have parallels you have two highly regulated industries, and you have, the big banks and big pharmas are good at regulation. They have deep expertise in that, and they're good at marketing and distribution. And both of them have more recently banks, but pharma also has recognized that a certain percent of innovation is going to come from the outside, right? That the world is changing too fast, there's too much innovation happening, that they're not going to be able to afford to build it all internally, so they have to look externally. And I think if you look in pharma, a good 70-80% of biotech companies that get funded by venture capitalists, take a lot of risk, end up getting bought or partnering with pharma. And I predict the same thing's going to happen in financial services.
Is part of that because are we over-regulated? I don't want to get too political. It's hard to do any panel without politics. But,
yeah.
But are financial services, in your opinion, over-regulated? And is the move towards deregulation a net positive for a lot of these fintech startups? Or is it dangerous?
I think it depends on what they deregulate, honestly. But I think at the end of the day, you're dealing with money, and people want to steal money. So and if money goes awry, that's much more dangerous than if an email goes awry. So I'm going to leave the regulation issue to the politics. There's going to continue to be regulation. I don't think it's going to go away. And so I think the ability of the financial services firms to be able to onboard innovation and make that part of not just a one-off, but a part of the process of running an institution is really important. Pharma has done that. They have known deal structures to deal with biotechs. We're not quite there with financial services, but I think you're going to end up, so to go back to your original question, some percent of the fintechs are going to grow up and become big companies and big competitors to financial services firms. But I think most of them, be they here or on the West Coast or in Boston, are going to end up being acquired or partnering with a large financial services firm.
But just to press on this a little bit, in talking to Michael, his point was a lot of these fintech startups were able to ride on the rails, and that's what made it sort of work this time around, right on the rails of the incumbent banks. When I look at Snapchat's S1 filing, they're heavily dependent on using Google's cloud-based storage and serving. They've got some diversification into Amazon, but ultimately they've been pretty clear they're going to have to build their own. It's too threatening to have those companies as the ones that are serving all their stuff. Are these fintechs going to turn around and say the co-opetition or whatever it is, at a certain stage it's not okay, and that means we're going to have to go get licenses, and inevitably that's just even for a $1 billion startup, that's not really feasible?
I think you can trust the capitalists to do what's in their best interest.
Yeah.
And so I think if a fintech gets to a certain size, and there can be a deal struck that everybody's happy with, it's going to get struck. So I don't think you can generalize. I think it's going to be very much case by case. I know with with the robo-advising area, I think that the financial institutions, investment management firms are looking at that field, and when there get to be enough assets that get to be with $1 billion, that becomes an interesting target.
Well, I'm glad you brought up the robo topic, and Tarek, I'll bring this to you. Why did that become so exciting and seemingly come out of nowhere? Was it a dissatisfaction that fees were too high, even on ETFs? Was it the failure of most actively managed portfolios against indexes and ultimately people just wanting this drive to a slightly customized index? Why are these robos all the rage right now? And maybe give a sentence, just because I'm sure there are a few people in the audience that don't know what a robo-advisor is.
Yeah, and I'm not the foremost expert on robo-advising.
But your clients, no doubt, are coming.
Clearly. Okay. I would take it to more of a macro level to say, and I think we discussed this as a group in the prep calls, the same principle applied to the Robin Hood story, right, from a brokerage perspective, which is, there was a legacy toolbox that was, decades and decades old that had been used, and people were now just, on the tail end and on the outside at an arm's reach of being able to use it in the way they had, and people were tired of paying $10 fees in the Robinhood example. I think the same principles apply with the robo-advising, where it is some of these things are more automatable, they're more streamlinable, and they can get to what they need to directly rather than going roundabout through the brokers and the various advisors in the old legacy model.
But a lot of these came out of the financial crisis, right? So you had a financial services industry which was being sort of, I don't want to say flat on their back, but they're in big trouble. A lot of new regulations, a lot of internally looking, and pulling out of markets. So SoFi, banks pulled out of student lending. Lending to small businesses, you had OnDeck that moved into that. So a big part of this, I think, was that you had gaps in the market. The banks were distracted. They were dealing with regulatory issues. They were dealing with the financial crisis. And that opened up space for new incumbents to come in and address and start. As you look, many of them started with a small piece, a very narrow segment, and then are growing from that. But I think the context of when a lot of these came into the world is important, because there was a lot of things going on that made it possible for them to get a foothold that perhaps if it were a healthier environment, they would not have.
But is it oversaturated now? I know you're going to tell me that it depends, but try to give me the answer anyway. If somebody came to you with a great robo, and the team was amazing, she went to MIT and majored in God knows what, are you interested, or do you feel like, oh, I've seen so many of these at this point, I'm like over it?
It would have to be in an asset class that people are not focused on.
And what would that be? Where do you not see enough? Do you not see enough in, I don't know, bonds, oil, commodity? Where is there not enough?
I think fixed income. I haven't seen too much in fixed income, actually.
Okay.
That's an area that people are, there's less, but fixed income.
David, I'm going to give you a viewer question. The way the viewer wrote it, the audience member, what did you assert on a 2016 FinTech panel that turned out very wrong? No doubt you were on some panels in 2016. What did you say that was completely idiotic?
Well, I do a lot of those, so I have to. I think that there were excitement about AI 2 years ago.
Yeah.
So I did attend some panel in the beginning where we're looking at the replacement of the human factor too quickly. I also think that some of the inspiration about using analytics to acquire customers were a little bit too early. And I think that there's a lot of companies that are thinking that they can go out and build amazing experiences and smart experience and just acquire. And I think in the end of the day, there's still a gap between that and actually being your bank. And in Europe, actually more in the United States, because of some of the regulation that allows them to do that, you see a lot of companies getting stuck there in that space. And again, a year and a half ago, it was a whole different story.
Why is Israel so good in AI? I mean, there was another company I remember during the dot-com bubble. I can't remember if it was like LivePerson or one of these other ones that came out of there. Is it Hebrew University? Like, where is all the AI coming out of?
So this is actually my second company, and before Personetics, I was the founder of a company by the name of Actimize, so compliance. So what's the common? It's analytics.
Yeah.
That's what it is. So we spend a lot of time in Israel with the analytics space. There's no Wall Street in Israel. So all the guys, my mother wanted me to be an engineer.
Yeah.
And that's where I actually came. Then we have the army, where they take us and they focus us on special programs, but they're dealing a lot with heavy analytics. So analytics and AI is...
and behavioral, too, because it's interesting. I'm reading that Michael Lewis book now, which is super boring. I'm going to stop reading it. But he talks about Kahneman and Tversky, who are actually... I used their papers in my thesis in college, but behavioral economics was basically born in the Israeli army.
Yeah.
Why do you think that is?
Because I think that they have a different approach. They try to explain. So they look at things. So the old economics said people, by definition, are logical people. They actually take logical decisions. Behavior economics came and said, no, that's not the case. And so the desire to challenge everything and to try to argue, I guess. And
I guess that's very Israeli.
Exactly.
Thing, right? Yeah.
And we do it all the time.
Okay, Michael. viewer question. Millennials are said to love a good deal. How much of millennials' interest in Ally is your sleek UI, and how much of it is your high deposit rate? Which, by the way, you guys pay 100 basis points on a savings account. Chase pays like 4, I think.
No branches equal great rates.
Okay, but I think this is a great question because it's like of your 2 children, your UI and your great rates. Which do you think they like better?
It's the intersection of those two, right? Because if you don't provide a great experience, then the rates really won't matter. The rates actually attract more of the well-heeled, purposeful savers because those rate differences make a huge difference. The thing that we're really interested in with respect to 21st century consumer research is that if you give them a great experience, they're willing to buy more in one place than other generations who had kind of a pick and choose mentality. So we think it's this combination of things where, rates matter for sure, but if you give them a clean UI and a great customer experience, they'll stay with you and do more with you.
Well, I think that seamless thing is a huge point because, I have an account with you, but I have an account with another unnamed bank, and I wanted one of their credit cards. And I had to go out and apply through a whole nother, and it was like, I have the cash in the bank here. Like, why would you possibly need me to go through this whole, so the knitting seems to be a huge necessity.
And that's something that we're working really hard on with respect to the online brokerage business that we're integrating now, because we want to avoid exactly that kind of experience.
Maria, what's the greatest frictional cost that can all but be eliminated in the next decade? And the second part is kind of, I think, too hard to answer, but it's what would the net effect be of that elimination?
I don't know if it's the biggest, but it's a pain point. I think Michael alluded to it. It's signing up for accounts. For small businesses, for individuals, the onboarding takes a long time of customers.
Yeah, I mean, I think about that all the time. Somebody asked me for a
It doesn't matter what it's
banking
for.
client.
If it's
No,
for a
but I think
credit
it's for a
card, it's
banking
for a banking
client. The question
account.
is, what is the cost of acquisition to open a new
If you're a
bank
small
account?
business, it can take months to it continues to shock me how long it can take you to onboard. So I think that friction of being able to get your customers signed up, working in this day and age, that'd be good to get away with
Where
that.
do you see the most light at the end of the tunnel on that? Is it bots?
I think this actually may be a place where distributed ledger and this whole identity thing that Tarek talked about, where there's a central place where you can go for identity. Because part of what creates the friction in the system is you have to make sure that they are who they say they are, that they're not laundering money, that they are not doing all the illegal things, and that slows the process down. So I think if you can figure out a way to meld that kind of technology where there's a central repository, that may help.
Tarek, you want to go for that one too? Greatest source of friction for your clients? Something that you think can be eliminated?
Yeah, I would fully agree with her answer right there. If I was to give another one, a little more out there, I would say that the brick and mortar costs that ultimately almost all of the incumbents bear will be something as a trend we'll see in 10 and 15 years from now, looking totally different than it is today. And I will very, I'm a proud admitter that I used to love going to Blockbuster. I used to love walking around and looking at all the videos and VHS and all that stuff. And didn't matter how much I loved it because the cost, that burden, ended up being too much to bear. And it was a good thing. I think the same thing is going through the branch right now, and people are trying to figure out how to transform and branch of the future. And I just don't think that there's ever going to be a branch that's ultimately going to be the Apple Store, right? I think it's going to be people go to the Apple Store because they want to go to the Apple Store and play with the stuff. They don't go. They go to the branch for the same reason they go to the doctor, because something's wrong or they have to fix something. So I think that as we look to the future, there's no reason that you can't partner and still have a physical presence if you need it, but it's untethered, and you partner with somebody who needs brick and mortar, and people do want to visit them, a coffee shop or something. And the technology is loose enough today that can work. So I think we'll see more of that, less dedicated brick and mortar for branches. And then we'll start to see that digitization just completely change the paradigm by which the new generation, I'm scared to say millennial now.
Yeah, me too. All right, so what we'll
I think
do.
somebody should have a delightful customer experience at a branch. You could
Yeah.
get some augmented reality, and you could visualize how, if you make money here, how you're going to spend your money. I think
All right,
people
so
should love
Michael,
that.
I'm going to bring you for one more and then stay up because I'm going to do a lightning round to end this. But Michael, viewer question. As you said, every bank today is a tech company that's innovating. So how do you stand out, and what's the future of innovation for banks? So I think the question is basically, if everybody thinks that way and everyone's competing, what do you do?
You have to run for where there's light and air, right? And so I think the fact that everybody recognizes that they're a technology company is not the same thing as being completely and relentlessly customer focused. And so you can apply technology on your internal processes. You can try to create new spins on the product using technology. But if you're not thinking about using technology in the relentless pursuit of a delightful, to use Maria's word, customer experience, then I think you're going to fall behind.
Okay. All right, lightning round. Stay right there. We're going to start with you, David. What makes you really optimistic and excited in this space? What is the idea that you have in the shower and you can't wait to get to a pad? What puts a spring in your step?
Well, I'm not going to talk about the idea, but I'm going to talk about the fact that after 20 years in financial services, the stuff that we do right now allows me to meet with CEOs and CIOs of banks. That means that they are starting to understand and care about digital analytics and customer experience. So that makes me optimistic.
We surpassed Silicon Valley in terms of the most fintech dollars invested, and we want to be there consistently.
It's just a cool time to be alive, to get to see all of these incredibly fun, interactive toys and tools and apps popping up, and to see that morph into actual platforms and a unified experience. We're right in the middle of it, so that's what keeps me going.
This one might surprise you and the audience. I think it's actually great that the regulators have become aware and sensitive to technological innovation, and they're not afraid of it. And I never thought I would see that in my lifetime, because that has the possibility to make all of these things work, like blockchain, like AI. And the regulators being excited about technology is something that I think is really going to accelerate this whole trend.
All right, well, it's a pleasure. Thank you to the museum. I love the museum. Thanks to Ally, Capco, Protiviti's got...
I have the enviable role of coming between you and cocktails. It's always a good gig. But I'm very funny, so you will enjoy this tremendously. I'm actually going to force myself into the lightning round and talk about the excitement of why it's a great time to be doing this. And I'm going to start with this. I actually live at the 9/11 Memorial, and our offices are at 77 Water. Come see us anytime. And so I walk by the museum literally every morning as I come to work. And as I was coming to work this morning, and I was thinking about these closing remarks, I was struck by a very funny thought, or at least I thought it was funny, which is, gee, I'm going to be delivering closing remarks about the future of finance at a museum. And then, deep thinker that I am, I thought, well, there's a lot of artifacts in museums that at some point were part of the future of finance. So how's that for being clever? Now, let's tie it back to what that brought home, which was, I was struck by a strong sense of time and place. It is February, it's Black History Month. And as we do every February, we host events about Black History Month. And last Tuesday, inside our offices, we had 4 Black African-American entrepreneurs talk to us about what their fintechs are doing. And, you know, our company, that's what we do. We work with fintechs. We work currently engaged with, I believe, at last count, 4 robo-advisors doing a strategic plan for a fintech, for a blockchain consortium, et cetera. So I see a lot of fintech. But not like this. There were fintech innovators that were looking at ways to convert consumer behaviors from simply being buyers of goods from companies into flipping the trust that consumers have when buying a product into the trust that is necessary to invest in a company. So that's immense, because that drives behavioral change and drives social change. And that's very important. I saw somebody else who was developing a solution to create credit worthiness within minorities. Obviously, you know, many citizens who belong to minorities have issues with having access to credit, either personal or for enterprise purposes. And creating that credit worthiness outside of the traditional scoring systems by analyzing their social networks online and creating the level of trustworthiness of the individual through measurement of their social support system. So, great time to be alive and be doing this. Also great time to be in New York City. To the question, there was a question that was sort of in the air about why is New York City fintech better than you know, Silicon Valley or other places? Well, there's a couple things, and they're quite measurable. One of them is that invariably the biggest wall that fintechs go splat against is the integration into enterprise systems. Fintechs come in, at some point you gotta exit the fintech ecosystem. Even if you're Venmo, at some point, the representation of money and the reality of money, the essence of money, have to meet somewhere. And doing that integration is a very painful process. Let's not talk about integrating robo-advisors who walk into clients thinking, gee, I can do this thing in 8 weeks. And then they go in there and, you know, they're integrating at a major global bank and they go, what? You need to know all these things? You know, but look, it works, it's frictionless, it's seamless, and it's brilliant. So being able to do that is something that comes with a mindset that is the right mindset, and that you only get if your provenance as an innovator is deeply steeped in financial services. And that's one thing New York has, is financial services. You know. So that's one thing. The other thing is obviously use cases. You know, we were talking about blockchain. What's it for? What can it do? What's the future of blockchain? Bridging the gap between what it is today as a promise and what it will be tomorrow as a reality is all in constructing the strategies around the blockchain. What do you use it for, and what the use cases are? Again, to do that, you need to get banks together. You need to get the users together, and you know, this is the place. So thank you very much. We are very proud to be a sponsor of this place that gives us a great sense of time and place and a great sense of purpose. Thank you.